All right, let's go ahead and get started. So thank you everyone, first of all, for joining. This is the August 2021 Life Design Analysis webinar. Hopefully you've had a great summer and are starting to turn that focus to September and really the end of the year, the big push to finally make all those elite groups and really close the year strong. August makes a great month to sort of do all the prep work, and one of the things we think about come the end of the year is term conversions, and we usually see a lot of term conversions in September. It's a really busy insurance month, so it's a good time in August to kind of get prepped for that. And we're going to show you some strategies on effectively illustrating term conversions, exchanges. We'll even do a partial term conversion. And I'm going to dive right into this. So we're going to be illustrating this today, obviously, on Life Design Analysis. And if you haven't used our software, if you're looking at us for the first time, I encourage you, if you do see something you like, absolutely try our 30-day free trial. On sign up, it is risk-free. We don't collect any kind of billing information, so you can try it, and if you don't like it, you don't have to go forward with it. Hopefully you like it, and again, we do have lots of different packages for you after that 30 days, but you will get the full feature set for those first 30 days and can make a decision after that. I'll also mention, though, that we do have a Life Guide discount if you are a Life Guide subscriber, so that's 50% off of a subscription up to the cost of Life Guide. So again, makes it affordable and gives us a lot of that great integration that I'm going to show you today. Now, I'm going to go ahead and log into my account. So LDA is a web-based software where, again, anything you'd like to access or all the concepts that I'm going to do today are accessible on any connected device. So again, simply navigate to lifedesignanalysis.com and sign into your account. Now, I should also mention this webinar is going to be recorded, so if you missed anything or want to go back and rewatch it, again, just navigate to that blog area where you registered, lifedesignanalysis.com. You'll see a recording after this, with all the details of the webinar itself. And as usual, for those of you who don't know, I am Charlie Conrad. I'm the founder and CTO, and I'm going to be hosting the webinar today. So we're going to jump into the first case right away, and I'm going to go ahead and just create a new case. And the first example we're going to focus on a classic term conversion. So we're just going to do a full conversion, and we're going to present an existing policy. Now you can see I've got a couple of sample in-force policies that I've pulled up. I've kind of blanked out the details. So I've got one that's a little bit lower face value here. So you can see this is a Manulife policy, and you can see basically here's all of our coverage details in sort of the policy contract. You can see it's for $1 million here. I've also got one that's a little bit larger. This is a $2 million one, and you can see the mail at the time was 34, but basically we can see we're coming up to that first expiration date, and what we want to do is really review these policies. So I'll start with the big, kind of the meaty one here to start with, and then we can do some other examples as well. So I'm going to just pop back over here to Life Design Analysis, and I'm just going to create a new client for the sake of this one. I'll call it Term Convert. Again, this person, the birth date on this client was 1978. So again, I'm just going to go over here and create my client here. So I'm going to say 1978, and I'll just say they were born August 20th. We'll just say it was today. Happy birthday. This happens to be a male, and again, I can fill in any of the additional details. These are really good. If you're not using a CRM, again, a lot of functionality in LDA to kind of track those contacts as well. You'll get things certainly like birthday notifications and policy notifications when you do have sort of your client info in there. So I'd encourage you to enter kind of additional details like email address, phone number, etc. For this one, again, for brevity, I'm just going to quickly kind of throw in some placeholder details. You can see, when we do put in an address here, again, we're going to see automatically LDA is going to fill out the rest of the details for you, so it really makes it easy to create your contacts in LDA. The more robust you make these details, obviously when you transfer those kind of details to an e-app later or look at your client record, just makes it that much, saves a couple minutes here, saves a lot of time later on. So you can see I've got my client created. I'm just going to go ahead and hit continue, and that's going to take us to the design case where we can really set up whatever sort of comparison we want. In this case, we're going to do the term conversion. Now I'll just show really quickly here, because we've just kind of created this new contact, you can see if I go to term convert here, you can see this is kind of my client record. Any of those details are going to be found here. Obviously, you can edit the client and change them around, and you can see because this is a brand new client, there are no real policies found because I've just kind of created the contact. You can see there are other things like file uploads, and again, we talked about this on the last webinar, that this might be a great opportunity to add the existing policy to the client file. Again, you could do that simply by clicking here. I have this one called existing. Let's see. .png, and this is our kind of existing policy that we're going to be reviewing. So again, you might think of even, if you do scan that policy contract, upload it to the file storage there. So I'll just say upload here. And actually, if you need to reference it in the future, again, you don't necessarily have to dig it up. You're going to see you're going to have a copy of the existing policy there. So again, just a thing to get in the habit of that, sometimes is nice just to keep organized. So if you ever need to review this or look at kind of the details of that contract, you're going to have it tied to that client file. Now, in jumping back to the case, because this is a new client and I haven't done any sort of policy import for this client, we're going to create this manually. And so there are two real ways to get this in there. One is manually throughout the design case here, so I can always add this product, which I'm going to do. You can also see from the client file, if I just kind of pop back to that screen, I can also add the new policy within their policy area here, or as I said, through an import. So a couple different ways to do it. I'm going to do it from the design case page. So you can see if I go on to my design case for term convert, really all I have to do is click the plus manual button and select the type of term product that I'm looking to add. Now this one happens to be a term 10, so that's what I'm going to select here. Now you can give it a case name. By default it says term 10, but I like to give it a really specific name, something like existing term 10, or in the case of the one we're doing, it's an existing Canada Life term 10. Give it a description. It could be like renewable and convertible. To age 70. And again, what we want to do is enter this existing premium schedule. So you see there's options for 3 right here where we can enter in the renewals, but based on the age of the client, we're going to get options for more and more. And you can see basically if I go over to my existing policy, the one we're going to review here first for $2 million, we've got this full renewal schedule here. So you can see basically when the $2 million started, this client was 34, quite young, so the policy was very affordable. You can see only $1,000 a year for the first 10 years. What we really want to illustrate though is because of the issue date and because of when they purchased this policy, they're very close to that next renewal date, and we want to show them those options. So basically what I'm going to do is I'm going to take this renewal schedule here and I'm just going to enter it as a renewal over here. Now keep in mind you can do monthly premiums, you can enter it, or you can do the annual premiums. Doesn't really matter. You can also do math in these boxes. So like let's just say it was $32 a month and I said 32 times 12. That you can also do that as well. So lots of different options to get it in there. Because this one's annual, I'm going to throw in that first premium and say $1,000. Then our first renewal was $5,140. And if you took a look, it jumps from 5,000 and then it went to 12,460. It jumps again and goes to 33,780. And you'll notice that, while there was 3 when I started, it always gives me the option for another one. Again, depending on the age of the client, they will have more or less renewals to the end of that expiration of the policy. Last one, well, not last one, 99,940. And our final renewal was $208,720. So something they're probably not going to pay per year, but again, we want to illustrate what happens to term over time. My stepfather would always say term is like a diaper, and at some point you're going to have to change it, and that's very much true about this policy. Certainly even on the first renewal, it's something that if we rewrote even just a term 10, we're going to do a little bit better in terms of premium, but it's all about presenting that opportunity to our clients, and really their age is the big factor here. So even going to some of these policies, I know this one's a year away, but going to some of them even 3 years, 2 years is really beneficial to seed that idea. Even if the time's not right, again, you can always review this every year with them until that point of the renewal. Now this one happens to be renewable till 85 and convertible to age 70. And what we want to do is we want to give it an issue date. Now this is very important. When we look at the existing policy, we're going to see that this one was issued April 23rd, 2012. So when we are in here, we're going to set the issue date. We'll go to 2012. We're going to pick April. And what did I just say here? 12th? 23rd. So go back here and pick the 23rd. Now, the reason I say this is important is because we actually use this issue date to track where the policy is in time. So, this one is 1 year away, but for instance, had it been issued in 2013, we'd see 2 more years until that renewal. And if we revisited the policy the following year, again, it keeps track of where that policy is in that time. So we always have an appropriate scale of how close that renewal is. Now, this one, I'm just going to give it a policy number ABC123, and the insurance benefit on here was just $2 million. So I'll just throw that in there. Now, the other really critical step that I would really encourage for everyone, and this is really important, if you want to save time in the future, I know, obviously it's not ideal. We would love it if we could get all of these renewals from the insurance carriers. Unfortunately, they always talk about the renewals are actually generated at the time that letter goes out from the policy admin system. So they often don't have access to these renewals other than in that sort of policy contract that we were looking at. But at LDA, again, we're always in the sake of trying to save you time in the future and make doing business more accessible and easy. What we want you to do is actually save this as a policy. So when I click this button, you can see there's a little save as a policy at the bottom. And what it does is when I hit save here, it's going to save that full renewal schedule over to Term Convert. So similarly to if I had imported a policy, we would have seen it in that Manage Policies area. Or had I gone in here into the client file and actually said add a new policy, you can see when I mark it and say save it, it's actually going to add it into this policies area where now we can see this for the client file. Now that's good because in any kind of future case I can always leverage it, but it also is going to add it to that policy automation. So at your 7, 8, 9, and 3 months to this issue date, it's going to automatically alert me as the advisor and say, hey, you should go ahead and review this policy. Now again, as I said, there are also benefits too, because in the future, if I ever need to pull this into a policy, you can see now all of a sudden, because I've entered one, we can see there's a plus in force policy. Now the next thing I want to do is actually add in my conversion option. So in this case, I'm going to do a full conversion. So I'm just going to go ahead and use this search rates function within our platform here. I'm going to pull in a min funded UL. I want sort of 3 options. I want sort of a middle of the road option, and then we're going to go for the full conversion on a whole life plan. In this case, because I know it's Canada Life, rather than going out of all companies, I'm just going to say Canada Life here. I'm just doing a min-funded sort of UL here for the full $2 million. But again, feel free to adjust this as you see fit. I'll go ahead and add that to the case. Now that we've got this added to the case, I want to add my final option, which is going to be a whole life. Now for whole life, especially with Canada Life, what we want to do is we want to import the spreadsheet from the carrier software. And the reason we want to do this is we want to show all of those paid up additions or whatever dividend option and whatever solve we pick. We want to be able to illustrate it with the full values. So, not just the guaranteed values, but we also want the total and as well as the reduced. And you can see when I add the Canada Life whole life, you can see there's 2 options. 1, I can import the spreadsheet file, or 2, I can paste the data in there. Essentially, to get this data, what we're talking about is basically over in the Illustrator here. You can see I've pulled up Canada Life's Illustrator. I've got my 43-year-old client. I've got the coverage set at $2 million. And you can see I'm doing an estate achiever max 20. So again, the only thing I want to change here really is I actually want to do this as annual because my other 2 products were annual. Again, feel free to customize this for your client. But you can basically see here's all the kind of the report information when we go to view data. So again, this is quite a substantial policy, but it's going to create a lot of value as well. So you can see basically I've designed it. There's $63,000 premium for the 20 years. After that, again, because it's guaranteed 20 pay, we're not going to see any more premiums. So to get this over in LDA, again, all I need to do is export. It's going to send all the information to Excel, and from here I can either save that whole file, or if we're doing the copy and paste method, again, select everything and then just select copy, come back to LDA here and just simply paste the information in there in the box. Now, it looks a little bit jumbled. For those of you using the platform, you're familiar with this. Again, we're going to sort that all out on the back end and basically import all of that information from the spreadsheet. So that's everything from, as I said, the guaranteed example all the way up to the primary example. Now again, I'm going to go in here and I'm actually just going to edit my plan to clean this up. So I'm going to call this and just say this is estate I'm going to say that this is a, maybe I'll just say it's a 20 pay participating whole life. So again, I've got kind of my examples. You can also see, again, my reduced example here in this is going to be the 1%. Go ahead and hit save there. All right, so I've got my 3 products in there. Now I want to do a little bit of customization for the case itself. So again, I'm gonna, now that I've got kind of the products in here, and again, if you ever wanted to see, kind of the details of them, you can always kind of scroll down and push these buttons to see, sort of what the premiums are. And you can see here, I might give this a case tag, so this is gonna make it easier to find it in the future. I tag all my term conversions with TC, and you might also give it a case title, which is gonna show up in the report, but it might be something like term conversion options. The other thing I want to do here is I want to add a little bit of a report note. So you can see, as we scroll down, there are internal notes for ourselves, but there are also report notes. And again, depending on the kind of the education of the clients, or perhaps how you've prefaced it, you might even add something like a term conversion note. So this just kind of explains what's required. It's a nice canned presentation to add in there. And I'm going to go down and just kind of review some of my report components. So I'm going to take out things like my mission statement. I don't have a needs analysis done for this client, so it's not going to show up. We've got kind of the plan details. That's all good. Can do kind of, these are good. I think the overlays are good. Presentation summary. We'll keep the internal rates of return. I'm going to take out the equivalent IRRs for this one, and I'm also going to take out the credit to the CDA because just not applicable in this case. We're not doing a corporate one. So I've got kind of my report components customized. I think that's a good selection for this case. Obviously, you can customize them to your liking, but basically all that's required now is to generate the report. And really, with a term conversion report like this, we really want the numbers to do the speaking. And really what I feel is just looking at the big picture and helping people see what happens to those renewals over time. All right, so we've got our report options here. Again, your logo is going to go there. It's prepared for term convert, the client. We can see the date of the report and who it's presented by. Again, go into a nice strong disclaimer. That's customizing your account settings, always recommended. And you can see kind of our first note. So we're really setting the stage, explaining the concept or explaining what a term conversion allows. So we're really trying to educate our clients, and they have, after we leave the meeting and everything leaves their head, they actually have something here that they can reference about what a term conversion is. And then we've got kind of the premium schedules here. And I think this is the really nice thing. So remember, I mentioned, sort of the issue date is what we use to basically just show what point in time this policy is. And you can see it's basically 1 year from its renewal at that $1,000 premium, which they're currently paying. But we can see from years 2 to 11, it's going to hit that 5,000 number. 12 to 21, the 12,000 number. Now you can also see that we highlight when something's closer, or an existing term policy, something that has an expiration. It's going to be highlighted here in red versus something more favorable like a universal life or our green, our whole life. And you can see again we've got kind of a nice summary of these different pricings. I find it's really effective to show the scale of these products. So I think initially when clients look at this and they see $1,000 that they're currently paying, you're asking me to pay 63 or 21, they don't necessarily grasp the scale of this full renewal schedule. And that's where I find visuals are highly effective at showing, here's where you currently are. In 1 year you'll be this, in 11 out to this. And as we look out over life, we're seeing that at some point we're either going to have to lapse this coverage or again convert at an increased age. And again, that's where you may want to go into a cost of waiting or something like that once you get the client to the conversation. But I find this is a really effective way at showing how the scale of those renewals really impact the future affordability of a product, or even the idea that they might even have insurance in the future. Now these are all interactive, so if you wanted to kind of click on and off, you can always take one of these options out. And you can see as we compare them over time, because the one is a 20 pay, we're going to see a break-even point at about year 39 here at age 82. And again, this is something where we might want to look at and say, were you going to be able to afford this all the way along? I'll also try and show a term rewrite as well to put it in there. I find if you do get objections around, oh, well, I'm not going to pay that guaranteed renewal, I'm just going to buy term insurance again, you can always do that sort of comparison as well. But I find this makes a really great comparison to just show that, look, over the long term, when do you want your insurance to end? Which line do you like the best? And I think a lot of people would say, oh, well, I want my life insurance to end when I pass away. And again, thinking about when we want to pass away, certainly most people expect to live, around life expectancy around age 82. And this shows, again, that more affordable plan. And again, the UL break-even point is even earlier, although there's not necessarily the kind of the value because we did a minimum funded universal life there. Now, when we get into sort of the value of the product, yes, we know it is definitely more expensive up front, and we do see that break-even, but remembering that there's cash value in this product, the whole life product, where there's no cash value obviously in that term product. And just, I find this is a great visual as well, just because, again, we know it's a guaranteed 20 pay, and we can see the value in the product around that break-even point. So, again, total cash value in the product, $4.3 million. So even if they were the same premium at that point, again, a lot more value in the whole life product. And so it almost negates the fact that it was more expensive if you had the cash flow to afford the product. Now, often you'll get questions too, is that a guaranteed value? Again, you can flip on and off these sort of toggleable charts and say, I guarantee you will pay $1.266 million in premiums, and I can guarantee that you get that money back right around year 26 if they never issued a dividend, right? And that's just the guaranteed cash value in the contract. You can also show that reduced example, so that's the -1, and sometimes it helps to contrast it with the total schedule there, but a great way to show value for that increased premium and why we pay that. I think the other thing that's important to note is, as we think about sort of our clients retiring, there is a cash flow issue, and with this plan, even if it was the same price and we kind of took out all those factors, just having the cash flow for increased cost post-retirement is something that is a consideration. So even with the UL, while it's more affordable product all the way along, and it certainly doesn't offer the value of the whole life product, maybe something an issue of affordability, because again, paying a roughly $21,000 premium in retirement may be something that's not built into that financial plan. So it may be better to build up value inside the policy and not have any premiums past that guaranteed 20 pay. So I think there's a couple factors there that really highlight kind of the different products. Again, the growing insurance benefit here is really attractive, starting at $2 million going all the way up. And again, this is a full-on conversion, so we'll cover maybe a partial conversion after this to show you that you don't have to do the full value. But this one does. Now, I find these coverage overlays are also great charts. Just really going through what's the insurance benefit, and you can see, the other two have a relatively flat insurance benefit. The one big thing, though, obviously that term policy there in red falls off at age 85, so there's no more insurance benefit after that. You can see, we still have the UL, but there's a big discrepancy in the amount of benefit we get. So you can see those paid up additions growing there. Of course, you can always still use the reduced examples and guaranteed examples within the legends here. If you wanted to highlight, maybe not the total coverage amount for Canada Life, but maybe something like the reduced example for Canada Life. So this could be like the reduced example versus the total. So again, you could do things like that. Again, we're going to adjust the scale, but again, still more value, still a lot more face than the universal life because of those paid up additions. At the end here, a nice little summary that just shows, here's you at year 1, and if we take you out to age 83, or, pick your target age, it could be like 85, we can expand that and see, just basically the cost breakdown here. So 1.7, Universal Life is a little bit, again, more affordable as we saw in the chart, but isn't going to have that same kind of value. And we can see here at 1.266, that's when we basically cap out. That's the end of our 20-year period. And after that, the premiums are no longer going to increase. We kind of just show that that's the total just to make it easy, but you can see they're kind of grayed out to just highlight that the premium schedule has ended. Again, we're going to go into sort of the presentation summary continued, and this is just going to compare the cash values of the products with the insurance benefits, really just highlighting the term plans have no value, the universal life had zero cash value or overfunding in it, and the estate achiever here had lots and lots of cash value and that growing insurance benefit. So just a really nice summary on costs and values. Again, things like IRRs are also a good place to look at. Only one of these plans really has a cash value, so it has the IRR there. The other plan, again, all of them had an insurance benefit, and this is just basically looking at the IRR over time. And I find this is a great metric to use because it really is, the great equalizer I find with IRR. Basically, whichever one is the better IRR, it takes into account, trying to make net present value zero. And this is, if you're trying to prove it to a CA or something like that, the one with the stronger IRR is always a very powerful metric. And obviously, with our term policy expiring at age 85, there's going to be zero return after that. There's no benefit. So again, proving right after age 78 that the whole life product actually has a better IRR on the coverage amount. Again, we want to look at the reduced example. We can see that pushes out that kind of break-even point here to age 84. All in all, not bad considering, we also had cash value that we could leverage inside of the policy, and we still had a better internal rate of return on the benefit. This is just kind of the table amount of it, so doesn't really matter if maybe you prefer charts, maybe you prefer tables. You don't necessarily have to use both of these. I just kind of broke it down to just take a look at the numbers, and again, it's easy to see that at age 83 we have a superior IRR. So that would be a great example of a term conversion. Again, I find it's really the kind of the villain in the term renewals that makes the whole life look so good. It's sort of that asymmetrical dominance concept. I mentioned though, again, a lot of clients will just say, look, hey, I'm 44 here, I can purchase insurance again. One of the things that you might want to show them in this case, again, if I go back, is just what age sort of does to those premiums. So I'm going to do the same sort of thing where I want to show, sure, you could buy a new term plan. And I really want to tackle that objection of, even if you reissued that term policy every single 10 years, again, assuming you're healthy and assuming pricing stays the same, so we'll disclaim that. I really want to show them what that would look like over time. So again, I'm just going to do a search for a 10-year term here from Canada Life. And rather than simply just say add to case, because I want to issue it, I want to show it as a reissue, I'm going to say add to case as reissue here. And you have two different options. You can see one stops on the guaranteed renewal. So at a certain point, the client's going to get too old to even purchase term 10. They would have the option to lapse it before it hits the renewal, or we can add it to the case as just a pure reissue. It'll do all those renewals. When they're too old to purchase insurance again, it'll just basically take the guaranteed renewal. So I'm just going to pick this one to I like showing that as an inflection point to say that sure, you could lapse it, but you will see that spike when you're no longer able to purchase insurance due to your age. There are certain obviously minimum issue ages that we have to uphold. All right, so you can see it's added it as a reissue here, Canada Life My Term, and you'll see that if I go into the edit plan, just to show you that it does automatically add that assumes good health and current pricing, because those are the two big assumptions we've taken. But again, more to handle that client objection of them saying, no, I'm going to keep buying it, again, making the assumption themselves. And we just want to model it to show that this is what happens even if you do purchase it every single 10 years, assuming you're healthy, get an offer all the way up until we get that guaranteed renewal. So I'll just generate this and we'll take a look. All right. So if we go down into our premium schedule, we've just added this extra one here, and you can see basically instead of going, again, they'd repurchase it here as we are at the 1,700. At the 11th year, again, instead of taking a guaranteed renewal because of their age, they'd reapply, and you can see that the premiums are still getting up there until those guaranteed renewals hit. So basically right here is where they were too old to apply. It hit the guaranteed renewal, so you can see that's when it jumps from 49 to 230. And then every year after, because the My Term goes to that YRT renewal, we're going to see a new premium each year. Now, again, same sort of visual when we look out yes, we could lapse the coverage here. So again, that's a conversation with the client as well. Or if you had selected that other option and said stop on guaranteed renewal, it would essentially stop there and not show this extra little 2-year tail where they are too old to apply, again, because of their age here being 83 past that last renewal here. And again, the product's going to expire. So in all likelihood, in this situation, the client would lapse that there, but we just like to show that, they're not going to get to that age 85 with it. And again, you can see, even if we take the assumption that, we're going to be healthy, we're going to repurchase every year, we're going to be standard health, all of that pricing is going to stay the same, it's not going to go up. Again, we can see that, we're still in that same ballpark with a lot of risk taken and no value. So even compared to something like that universal life plan here, we can see we're very, very close in premium. Obviously, less expensive than taking all the guaranteed renewals of our existing plan. And again, still less expensive than the whole life, but coming back to that kind of value proposition, remembering that there's a ton of cash value and an increased insurance benefit there. So great way to kind of model that out and show that, even if you do stay healthy, it's quite a considerable cost because of our age. And again, those are some pretty big assumptions there. So it's more of an objection metric to model it out, but a really, really good one. So, that's a great way to set up a term conversion case that just kind of illustrates the numbers. We present it to our clients and walk them through and show them the value. Now, you don't necessarily, as I say, have to do a full conversion there. Lots of different options, because I realize that's a, sort of a really big premium. But let's do maybe a partial conversion and show what that looks like. So let's set up another case here, and I'll show you another way we could structure this. So I'm just going to get rid of my reissue term here. Again, if you were actually wanting to use this as an ace up your sleeve, you might leave it in the case and just simply hide it from the report. I'm just going to simply delete it to get it out of there, but I do think it's a great one to use for our clients who think they're going to repurchase every year. Now, while that's loading, I just want to go over to our software here. I'm going to get rid of my old quote. And basically what I want to do is I want to make this a little bit more palatable for my client. So again, that was a really high premium, but I don't necessarily have to do the full amount in paid up editions. There's lots of different options to make this more affordable. So one of the ways we could do it would be something like a partial conversion. So again, pick your number, whatever you think that, sort of the premium might be. Maybe it's $1 million of base. Let's make sure I get that right. 2, 3, 4, 5, 6. That's perfect. And I just want to add a term rider for 20 years as well. I'm going to use the other $1 million there. And with this one, I am going to say let's lapse the coverage at a certain age, because we don't want those guaranteed renewals to go in there for this client. We're basically trying to hope the paid up editions will sort of cover that. And so this guy's 43, and I'm just going to say till 63 then. 63. Update summary. And again, same sort of thing. I want to view the data. I want to export it to Excel. You can see a much, much lower premium here. Obviously, the term rider in there makes it a little bit more palatable. I'm going to copy that. We're going to come back to our case here. And again, if you ever need to override this sort of product that we have in here, again, we can just simply drop down. You can see when I drop down with this little chevron, I get the option to paste spreadsheet data in there. So same sort of process. This is just going to override the $63,000 premium and replace it with our new file here. Now basically I want to go in here and I just want to say guaranteed 20 paid participating whole life. I'm just going to update my note here and just say $1 million base plus term 20 rider. So again, just update that kind of scenario there. Go ahead and hit save. That's just going to update our product description. All right, so we've got our new plan in there. Let's just go ahead and generate this report and look at what a partial conversion looks like here. All right, so we've got, again, our same standard report, term conversion note. May want to add something in that note for partial conversion, but you can see we've got a lot more palatable premium on that whole life. Again, our little note about, kind of the total coverage and what it's kind of composed of goes there. And again, much, much more palatable kind of premium schedule. So we're a lot more in line with, sort of the expectations or, kind of the premium that's a little bit more palatable there. And you can see that obviously has adjusted our break-even point here But the interesting thing is there's still a ton of cash value in this product. With the rider, again, we're going to see that we do start with $2 million. There's a little bit of a gap here. You can see at age 63 where, again, that coverage drops down. That's that term rider falling off. But you can see because of those paid up additions, we're back to that $2 million mark at age 75. And again, that might work really well with your client's needs. You know, they may have young children who in the early years, they need a lot more coverage. They have a mortgage, a house, but, you know, post-retirement, they really don't have the same need. They just have, you know, kind of estate planning needs to cover things like, you know, maybe it's a tax liability, perhaps cottage, second property, that kind of thing, legacy, lots of reasons. But again, you know, this kind of partial conversion allows us the opportunity to, you know, design something that's a lot more affordable, but still has a ton of value compared to those other options. Even when you do the overlays, again, as I said, there's going to be that small little triangle there where the other options have more insurance benefit, but overall those paid up additions are going to, you know, kind of overcome that. And again, you might want to look at things, as I said, like the reduced examples of the coverage as well, just to make sure, you know, how that's going to impact it. Again, you know, when we look at sort of the reduced coverage, we can see, you know, same sort of drop, a little bit less values, but overall a lot more palatable. The other thing that I would say, you know, it doesn't necessarily have to be a full paid up addition plan. So again, the other option to make something a little bit more palatable would be simply just go back over to our illustrator here. This time, rather than, you know, sort of I'm going to actually pump it back to 2 million. I'll make the coverage 2 million. I'm just going to get rid of my term rider. And rather than paid up additions, what I'm going to do is I'm going to do the enhanced coverage lifetime guarantee. And actually, I just want my total to be 2 million. So I'll update that. So basically, again, we've got our enhanced amount. You can get creative with that and play with it a bit, but same sort of thing. Let's view the data, export it to Excel. And this would be kind of a full conversion, but to a different dividend option. You can see we're sort of middle of the road there. We've got about a $40,000 premium, so a little bit more expensive than the term rider, but same sort of process here. Again, let's paste that spreadsheet in and override those values we have currently. And you could also add these as other plans. I mean, this might make a great report in itself to, you know, once we kind of get our client on board with the fact that, you know, the term is, as we say, like the diaper, we can then kind of explore the options as a standalone report. So I'm just going to say this is guaranteed 20 pay instead of participating enhanced div option. So again, I'm just going to update that, take out this, because we don't have our term rider in there anymore. I'll just update that case. And we can go ahead and generate a report and just see how that kind of looks in the overall picture. All right, so same sort of report. As I said, term conversion, no, we've got our policy here, a little bit different premium. Again, same sort of thing. You can see a much more palatable line. It's similar, a little bit more expensive than the other one, but again, the overall messaging is that, you know, it's less expensive than those existing term plans. Again, you may want to compare it to a term rewrite, and we'll be within that same sort of ballpark again in terms of break even at a much earlier year, and still creating a lot of value with that enhanced option. Again, you can still see the guarantees, you can still see the reduced values, but overall, you know, we hope it's very competitive compared to these other options, right? We never have a deficit in terms of insurance benefit, and after basically the goal is that those kind of the paid up additions buy out that YRT inside the policy. Then after the YRT is all, you know, refunded, I guess, so you're purchased out and replaced, you can see it starts to grow as if it were a paid up addition plan. And again, you can see, you know, if you do things like the reduced amount, that's going to push that off. So here's kind of the reduced amount here, and you can see, you know, rather than, you know, year 70 where it starts building, you can see it's pushed all the way out here till about year 79, so age 79 I should say, and that's when you can see that paid up addition basically starts growing because that YRT has been replaced, and that's that 1% reduction. But again, really solid plan, keeps the full face value, a little bit more palatable, and again shows, you know, sort of against a term plan or even against a UL that they'll continue to pay, that we sort of satisfy those objectives, right? Offset at 20 years, you know, satisfies our cash flow, we're not having to pay that premium. At some point, it's the more affordable option, especially the longer we live. and we still have the values in there that make it palatable. So I think that makes a really great presentation. One of the other things, like I still think IRR is better, but one of the things you may want to do is add a present value to this as well. Just one of the arguments in kind of the insurance world, I'm just going to set a 2% discount rate. Basically, to add a PV, you would just say calculate with present value. You can set that discount value, that's the R value in the formula. Generally, that would be your inflation number. I prefer IRR because it kind of works backwards to find what makes net present value 0 versus specifying kind of an inflation rate, which over the next 30 years is likely not going to stay consistent at 2%. But this is, kind of a good average. You can see it's going to put that PV disclaimer in kind of your disclaimer, and you're going to notice that basically our annual premium schedule here is adjusted for that time value of money. So saying, basically, as that premium schedule, the argument is basically, yes, the term policy does increase in cost, but because of things like inflation, it's not as drastic. So you can kind of see that this is adjusting for that inflation and basically lowering the kind of what a dollar would purchase in then. So that, that's kind of the argument for present value. Now, the same sort of thing happens when we look at the chart. Again, a little further breakout point because, again, we've paid all those dollars now where they're worth more versus in the future where inflation has reduced their purchasing power. But the same thing sort of happens to the insurance benefit as well. So if we look at something for like the existing Term 10, sure, it starts at $2 million, but $2 million in the future doesn't have the same purchasing power. So this basically adjusts it on a 2% inflation rate or a discount rate, saying that, basically in 32 years, or let's go right to the million here, basically in 35 years, that $2 million in the future has the purchasing power of $1 million today. And so it's just trying to adjust for that. Yes, the argument is that those renewals won't be as drastic, but remembering that our insurance benefit won't be as well versus, and that's true for the universal life as well. But because we have paid up additions and we have sort of the enhanced plan, you can see those paid up additions actually help fight, that devaluation or essentially of what $1 million buys. So again, it is a really good protection for inflation to have something like paid up additions or some kind of enhanced coverage, some kind of dividend option on there. Again, so you can adjust those for PV. Now, let's go back here to our case here, and we're actually going to go to actually create a new client. I want to show you two things here. I want to show you again how we can set up a new case for maybe something like a term reissue. So again, if I start up a brand new case here, what we can see is because we entered the in-force policy before, ABC123, I can pull it into a new case without having to re-enter any of those options. Again, it just wants me to verify that it is still a Term 10. I'm going to go ahead and save that so it can fit those renewals inside of the right schedule. All right. Now with this, we may want to show them, this policy, most exchanges are really within the, kind of the first 5 years of the policy. Canada Life and some other carriers, I believe, have up till year 7. Obviously, the client has to be under a certain age. Usually it's age 65 that they have to be under to do the exchange. One of the things we allow you to do, though, if you were, if we had this client and maybe they don't have the affordability for permanent product, we can also show them how they would do an exchange. And so in this case, I'm going to do a term exchange here, and I'll show you one way to kind of illustrate this off the get-go. Basically, again, pick our insurance benefit. This one's going to be $2 million. We're going to do a 10-year exchange, and again, we'll search for Canada Life here again, just keep it consistent. Basically, from that term page that we saw before, same sort of drop down where we drop it down, where we picked the reissue here. Reissue. We can also see, we can illustrate it as a reissue, but they're exchanging it. And you can see we have options for 5 and 7 years. And basically what this is going to do is it's going to look at it and try and model it out and say, yes, you can buy the T10 currently at this price. And then after 5 years or 7 years, let's change that and exchange it to a T20. And basically that buys them a little extra time. Now in this case, I'm going to say we're going to reissue it at the 5th year, just to keep the numbers kind of more even. But again, that's totally your option in terms of which one that you choose. All right, so this is run here, and we've got kind of our existing term policy versus a new exchange. And again, we can go ahead and generate that report. Again, our disclaimer, mission statement. You can see basically our policy in time now versus if we picked an exchange to a T20. And what this looks at is basically years 1 to 5, we're going to see our current premium that we apply for. But in year 6, we're going to actually exchange that to a T20. And you can see it's going to go to a T20 after that. Again, assumes current pricing. We don't know what the pricing for term is going to be like in 5 years, but for illustrative purposes, it's a really good example to show what options the client has. So again, in 5 years, they exchange to a T20. And again, they're missing out on a lot of those renewals that they would have seen, right? So it's a great strategy. I find this is a really, really good strategy for people who are buying term insurance for a mortgage. Generally, especially first-time home buyers, you're strapped. There's a lot of costs, land transfer tax, all of that. So the term 10 seems really palliative. 5 years out, things are a little bit more stable. Maybe you've had a raise, things like that. Again, switch to a T20, it's got a higher premium, but again, it's going to be locked in for a longer time. So when we look at sort of that cost comparison here, again, we can see it's a lot more affordable, and again, gives us the same sort of coverage. At the end of the 20th year, again, we're gonna be 68 here. We've saved a lot of money versus the current plan that we have, and again, we still have coverage. At that point, we can either convert the full amount, partial convert, but it does buy us a little bit more time. So if maybe for our younger clients or clients in a kind of a different economic bracket, something like an exchange might be a little bit more affordable. Now, if you went back to our example, as I said, our client on our existing policy wasn't necessarily, because it's 9 years in, wasn't able to do that exchange. But let's just pretend for a second that this policy, maybe it fits within kind of that range. And if you wanted to take an existing policy and say, how does it compare? You could do the same sort of thing. So I could say, let's do a manual term 10, and we'll pretend, for example, like we know our first premium was $1,000, and so I'll just say term exchange. We'll just say exchange it the 5th year. And so in this one, I'm just going to trick it a little bit. I'll use this kind of renewal schedule, but basically what I'm going to do is I'm going to say, we know it's $1,000 now, and we're going to pretend that in 5 years into this policy, that we're going to basically convert it to a T20. So I'm going to kind of mess with the issue date here just for illustrative purposes. And I'm just going to say it was issued August, let's say 26th or 25th. Of 2016, making it, basically 5 years old and fit within that. And then basically what I want to do is I want to look at, sort of what a term 20 would cost for this client right now. And I've actually just pulled up plan specifications. I'm just going to kind of do a quick survey here on a 20-year term, just at kind of our current age, to say, let's pretend we've paid this one for 5 years, and basically what we're going to do is we're going to switch to that T20. So again, if I go down, I can grab kind of my premium going forward, and I can see it's $2,900. And basically what I'm going to do is I'm just going to copy this, come back to our form, and because this is kind of the term 10 that we're putting in there, I'm just actually going to throw in these two, so basically making it 20 years. Again, following that, we'd see a full-out renewal schedule, but for the sake of this one here, I'll just simply save that. Now, the other thing I'll do just to kind of match this is just edit the other issue date here, and just kind of back that one up to the same time just to illustrate this. Again, we're going to say 16 and move it up. So let's go ahead and generate here and just see what we've got. All right, so we go into our plans again. We can see our existing term plan. We'll say years 1 to 5, it's $1,000. Years 6 to 15 jumps to that guaranteed renewal. Here's our exchange option. So saying, years 1 to 5, it's going to be 1,740, and then it's going to jump to 5,000. That was the term 20. And this is sort of our T10 exchange that we did, saying, hey, look, we could do this. Again, in this example, we're pretending that basically from years 1 to 5, it's that same $1,000. But at year 6, where we exchange it, it goes to $2,900, which is basically the current T20 premium. And again, when we look at that, and I'll just get rid of the exchange other option, basically shows them that yes, on your current path here in red, you can see that we're 5 years away from that guaranteed renewal. But if in sort of the 5 years we actually exchanged it, we could then have a policy that skips those next kind of 2 renewals. So a really good kind of comparison, and really works well versus a traditional T10. So if someone with a mortgage who can basically exchange that, has a great option to lock into a longer term product, but basically retain that same health rating. So these are great opportunities to present options to your clients that keep them with insurance for a lot longer. So some good options there. Now, I know a lot of people are thinking, that's fantastic, but where do I find these clients? And that's where I'd really encourage you to import your block of business. If you'd like, again, reach out to us on live chat. We can always help you with that. Brandon from our team is excellent at bringing in blocks of business. We have a form, you can request them. You can also request them on the import clients area. But basically, when you do import all of the clients, that's going to populate the manage clients area of the site. And from this managed area of the site, this is where, again, you can filter into where are your best term conversion opportunities, where are the best exchange opportunities, where are the best term 20 opportunities, and even the overdue ones. So for example, if I was looking for, again, term 10 conversions, all I'd need to do is simply hit the term 10 filter here and give it a click. And you can see it's going to filter out all of my best opportunities. So again, based on product type and issue date, I'm going to be able to isolate certain policies that fit my needs. And again, you can see that this one is coming up because it was issued August 20th of 2011. We know that come August 20th, again, it is going to be up for renewal. And so again, this is going to give me my list. You can see again, here's a CI policy. That would be a good one. We wanted to approach them and say, look, you have an upcoming renewal. Let's review this versus the other options. Again, you can see it's going to basically go down the list. We can look at certain ones out to October, but it's using that issue date on the policies to show me my best opportunities to convert these kind of term products. And again, the same sort of thing works with term swaps. It's going to focus in on a little bit of a different time period. So again, these are going to be term policies where we basically use the issue date. We look out 2 years out to kind of the 5 and look for opportunities that would a little bit newer term 10s. So again, based on issue date, you can see these ones are 2016. So, in that 5-year range where, again, they're kind of at the end of that option to exchange them. And you can also filter out by overdue term 10. So you may have clients within your block of business that, for whatever reason have gone over that guaranteed 10-year period. And you want to, again, highlight to them they have an issue here. So anything that's gone over that 10-year period is basically something that is an opportunity. So again, these ones that June and July, again, of 2011, they were issued, we know that they've crossed over that 10-year mark. And these are either policies that, again, we need to touch base with the client because they're either paying too much or they're paying that guaranteed renewal, and either sell them a new term product or explore those conversion options. Now, if you are looking to review an existing term policy, we do have a really, really great blog on how to review a term policy that basically takes you through some of these filters, how to find certain policies, how to crunch the numbers that we've done today. So it's more of a step-by-step guide, just showing you kind of how we set up these cases and then what you might want to compare them to and the analysis. We've also done kind of that save a policy so you can see that as well. The other thing I'd point out as well is that we do have kind of a term conversion campaign. So it's great when we have a specific client to go after. You may want to cover a lot of clients and set up kind of a marketing campaign towards them where basically you would set out an email and ask, is it time to review your term policy? So essentially, we kind of isolate all those term policy holders. We send out a mailer. This is an example template. It's a MailChimp template that you can actually download if you'd like. It's fairly generic. You can put your own logo on top. And it just talks about what a term conversion is, what the benefits are, and what you might want to consider. And you can see at the end of it, again, if you want the free term conversion one, you just basically download the template. But basically at the end of it, you can say, view a typical term conversion example. And that's where you can actually set in an example of how that renewal renewal point goes in LDA, and of course put your contact info in there, so that would be email. And if you think about sort of a marketing campaign built around this, you might sort of build toward this. So you might download the template here to set up a term conversion mailer and send this out to all of your clients with term policies. Now, obviously this is going to generate some interest, but it makes a lot more sense, even for the people who don't respond, that when you follow up to review their term policy, that you've sent this in advance. So it's kind of the 1-2 punch that if you wanted to scale these efforts, basically you can send out, a term conversion. Your call to action is saying, do you want me to review your term policy? And when they do, again, you can perform a term review and help highlight the benefits of permanent products, partial conversions, exchanges. It really opens the door to that. But hopefully that gives you some ideas on all about term conversions. As I say, if you do have any questions, definitely sign in or sign up free to the site. And you can always reach us on our live chat to help walk you through this, or if you needed a second set of eyes. So I really want to thank everyone for joining today, and hopefully that gives you a lot of ideas on how to get productive come the end of the summer. It's a great time to sort of collect those term policy holders, import your policies, really do some planning on who has upcoming renewals, and build some cases for them. Again, as I say, combine that with a mailer that kind of increases the exposure to it, and follow up with a case reviewing their specific plan is a really good opportunity to make that September, October, November, December, end of the year a really, really successful for conversions. So thank you so much again, and look forward to seeing you on the next webinar. Take care.